In this video, I'm going to go through this demonstration problem to practice debits and credits in T accounts. And hopefully you watched my previous videos where I explained all of this and I explained how you record transactions using journal entries with debits and credits. And then whatever you do in the journal, you copy over to the ledger. Those same debits and credits get copied over. And I talked about how the T account is an informal ledger, but it's also the easiest place or the easiest way to learn debits and credits. So what I'm going to do in this problem is get you comfortable with debits and credits, hopefully, and then in the next few videos after this, we'll talk about journal entries. Okay, so in this problem, this is Smith Consulting Services for the month of November 2025. The owner's name is Joe Smith, and these are the accounts that we're going to use to record transactions in. And this is organized by account type so that you can easily see what account type each account is. And then here are the transactions that I'm going to go through. And then I added this image here with the debit credit rules just to remind you of what those rules are. If it's an asset, withdrawal, or expense, we're going to add to those accounts with debits, subtract with credits. Everything else is the opposite. If it's a liability, owner capital, or revenue, we're going to add to those with credits, subtract with debits. Okay, so I'm just going to go through these one by one. The first transaction is the owner withdrew $50,000 from personal savings and deposited that money into the business checking account for Smith Consulting Services. So this is an owner investment. And I know it says checking account, but we're going to use cash to basically show the checking account. What we want to do first is look at what we're adding and subtracting to. What accounts are affected here? Well, the cash of the business just increased by $50,000. Cash is an asset, so we're going to be adding to cash with a debit. And then this also increased the owner's investment in the business, which is capital. Smith Capital is going to represent owner investments. And this is an equity account or capital account. We're adding to that account with a credit. So what you're going to do is put $50,000 on the debit side of cash to add to cash, and then on the credit side of capital to add to capital. So you have a debit and a credit. Remember, we have a double entry system here. If you put a debit somewhere, you have to put a credit somewhere else. Okay, and then the business paid $5,000 to purchase a computer and other equipment. When you see the word paid, assume that means paid cash, unless it tells you otherwise. So that's going to subtract from cash if they're paying money out of the business. And they're purchasing a computer and other equipment. So that's going to add to the equipment of the business. The business just increased the amount of equipment they have. So we're subtracting from cash. When you subtract from an asset, that's a credit. So I'm just going to put $5,000 on the credit side of this T account. And then we're also adding to office equipment, which would be a debit. So we're adding to one asset, subtracting from another asset. Okay, then the business paid $2,000 rent for the current month. If they're paying something again, that's going to subtract from cash. And then this also adds to rent expense. When you add to expenses, you're doing debits. Whenever they have an expense, that increases the expense of the business. So we're going to put that in rent expense on the debit side to add to it. So I know you might think of expenses as something you take away from the business, but at this point, all we're doing is getting totals so that those totals can go on the reports. So for something like rent expense, we're just going to keep adding $2,000 to this expense every month, to this expense account. And then at year end, they can see the total amount that they paid in rent expense for the year. Okay, and then the next one, the business paid $500 to Resource Supplies to purchase office supplies. Office supplies is an asset, so that's going to add to office supplies because they're increasing the amount of office supplies available in the business. And that's also going to subtract from cash because they're paying for something. Well, you're adding to one asset, which would be a debit, and you're subtracting from another asset, which would be a credit. So we're going to put $500 on the credit side of cash and $500 on the debit side of office supplies. So that's how that transaction would look in the T accounts. And then the business purchased office equipment for $12,000 on account from Office Plus. So when you see the word on account, that typically means it's an accounts receivable or an accounts payable. In this case, since they're purchasing something and they're going to pay for it later, this would be an accounts payable. They have a debt. So we're increasing the amount of debt in the business. You add to liabilities or debts with credits. So we're going to put $12,000 on the credit side of accounts payable. And then you would also add to the office equipment account for $12,000 because they just purchased office equipment. Now they have additional equipment available in the business. So I'm going to put $12,000 on the debit side because this is an asset, and we add to assets with debits. And then in the next transaction, they earned $11,000 in revenue from clients who paid cash. That's going to add to revenue because they earned revenue, and it's also going to add to cash because they received cash. When you add to cash, that's an asset, so that would go on the debit side of cash. So I'm just going to put 11,000 here. And then that's also going to add to service revenue, and you add to revenues with a credit. Then in the next one, they earned $4,000 in revenue from clients on account. So again, you see the word on account. On account is either an accounts payable or an accounts receivable. In this case, it's an accounts receivable because they expect to receive the payment from the customers later on. At this point, the customers haven't actually paid cash yet. So we would be adding to accounts receivable to show that those customers owe the business money. And then we're also going to record that in revenue because the business did earn revenue when they performed those consulting services to the clients. In the next transaction, the business paid $2,500 to Office Plus towards the debt of $12,000. So they're referring to the debt up here where they purchased equipment on account. They're simply paying $2,500 towards the $12,000 that they owe. So this is going to affect cash because they're paying for something, they're paying cash, and it's also going to affect accounts payable. So it's going to subtract from cash. So I'm just going to put $2,500 on the credit side of cash. Cash is an asset. So anytime I subtract from cash, it would go on the credit side. And then I'm also going to put this on the debit side of accounts payable. When they make a payment towards a debt, that subtracts from debt. It subtracts from a liability. When you subtract from debt, subtract from liabilities, that goes on the debit side of that liability account. So accounts payable, when you owe money, you add to debt. When you make payments, that's going to subtract from debt. Now notice in this transaction that I did not do anything to the equipment account because I already recorded the $12,000 equipment purchase here. All I'm doing in letter H is show that they made a payment in cash towards the accounts payable. Then in the next one, charge account clients paid $3,000, reducing the amount owed to the business. The business, in other words, is receiving $3,000 from those customers, from those clients. And when it says charge account clients, it's referring to this accounts receivable. From the business's perspective, they're receiving $3,000 from these clients. That is going to add to cash. We add to cash, which is an asset, with a debit. So I'm just going to put that on the debit side. And then that's going to subtract from accounts receivable because these clients paid towards their debt. So for accounts receivable, when clients owe the business money, you're adding to accounts receivable. And when the customers make payments, that's going to subtract from that accounts receivable. So that would go on the credit side of accounts receivable. For the next two situations, they are simply paying expenses. First, the business paid $6,000 in salaries to employees. That's going to add to salaries expense. Remember, for expenses, we're adding to the expense account to get totals. And then at year end or month end or whatever time period you're doing a report for, you're going to get that total and put it on the report, and it will subtract from revenue at that point. But at this point, when you're recording the transaction, you're just adding to the account. Just think of it as you're adding to the account to get a total. Or you could think of it as you're adding to the expenses of the business as they have expenses or as they incur expenses. Okay, so that is going to add to salaries expense, and they paid something, so that subtracts from cash. We are subtracting from cash because they're paying something, so that subtracts from an asset. And then adding to expense with a debit. Okay, then they paid $800 for utilities, and this is the same situation. We're going to add to utilities expense because they incurred an expense. And then it also subtracts from cash, which is an asset, so we subtract from cash on the credit side. So $800 would go there. And then in the last transaction, the owner withdrew $3,500 for personal use. That's going to subtract from cash, which is a credit. And then we're also going to add to the withdrawals, to the owner's withdrawal account. It's similar to the thought process of an expense. We're going to keep adding to this account as the owner draws money out. And then at the end of the year, end of the month, end of the period, we're going to get a total so the owner knows how much they withdrew. Another way you could look at this is withdrawals is technically an equity account. When the owner increases equity, when they're investing money, we're crediting to add to capital. And withdrawals is the opposite. It's the owner taking money back out. So we're technically taking money out of equity with this debit. And then once you have all of your transactions in the T accounts, all your debits and credits are there, then you would want to get your ending balances. To get your ending balances, you would put a little line underneath the transactions, and then you would do your mathematical calculations and put the balance underneath the line. And remember, debits add together. So for cash, we're going to be adding the 50,000, the 11,000, and the 3,000. And then credits add together. So we're going to be adding all of these credits on the credit side of cash. And then you would take the difference. So for cash, you have 64,000 on the debit side. And you have, if you add up these numbers, these credits, you would get 20,300 on the credit side. Well, the 64,000 debits minus the 20,300 credits would give you a balance of 43,700. Now I'm going to put the balance on the debit side because these debits or 64,000, which is a larger number than the 20,300 that's on the credit side. So you put it on the side of whichever side is bigger. Okay, let's do that for accounts receivable. This one's going to be a little easier because you just have one debit and one credit. So the difference between the debit and the credit is just $1,000. And since the 4,000 was larger than the 3,000, the balance is going to go on the debit side. So that's what your answer would look like. And then for office supplies, there's only one number. So your balance would just be $500. For office equipment, you would add the two debits together to get a balance of $17,000. For accounts payable, you have $12,000 on the credit side, $2,500 on the debit side. The difference between $12,000 and $2,500 is $9,500. And this time, your balance would go on the credit side because the credit of $12,000 was larger than the debit of $2,500. For capital, you've just got a $50,000 credit balance. Withdrawals just has a $3,500 debit balance. For revenue, you're adding the $11,000 and $4,000 together to get a credit balance of $15,000. And then these expenses down at the bottom just have one number, so that would be your balance. I'm going to go ahead and put the answer key over here so you can see what these look like with all of the lines in here. Now, I don't have EAL in a lot of these, but you could certainly put that in there if you wanted to, like I did on the other sheet. But basically, this is what it would look like when you are done. Once you have your ending balances from the T accounts, then you're going to bring those balances down to the trial balance. The trial balance is just a list of accounts and their account balances. And you would list these accounts in the order of the chart of accounts. So assets go first, then liabilities, then your equity accounts, then revenue, then expenses. And that's already filled in for you. I put this filled in on the blank worksheet to save you some time. And then over in the debit and credit columns, you're going to want to put your ending balance from each account. And just make sure you're putting it on the correct side as far as whether it's a debit or a credit balance. And then what you would want to do is make sure your total debits equal your total credits. So I'm just going to go ahead and bring over the answer key so you can see what it would look like. So this is what the answer would look like. You would just be taking these numbers from the bottom, the balance from each T account, and put them in here. And then if you add up the debits, you should get 74,500, and you should get the same number if you add up the credits. So this tells you that your total debits equal your total credits. And that's all I wanted to go over in this video. If you have any questions, feel free to comment below, and thank you for watching.